David R. Guttery is the Chief Executive Officer of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, CEO of Keystone Financial Group in Trussville, to discuss market volatility and the economic uncertainty that may have caused it. David, thanks so much for being with us today. Wow, a lot has happened since your last video. We've heard about tariffs and reciprocal tariffs and trade wars and growth shock. We've heard that the odds of a recession were skyrocketing and market volatility was palpable while all of this was happening. David, what are your thoughts here? You've said in the past that sometimes perception is different from reality. Is the market just overly nervous, or are you concerned about the direction of the market and the economy?
Think of instant replay in college football. You just thought you saw the runner fumble the ball. That is, until you see the reverse instant replay angle, and then it's clear that his knee was actually on the ground before he lost the ball. Indeed, in my opinion, there is a stark difference between reality and what you're hearing across business, mass media outlets, and social media. Your perception of what's going on in the world is a function of your perspective. And it's been 5 years since we've been able to take superficial observations at face value. You must look more deeply than just the surface, and from many perspectives, if you truly wish to understand the financial and economic forces that are at work. To your point, there has been palpable fear in the stock market lately, and we can quantify this with a number of metrics. The overarching question, though, is, what is the source of the fear, and is it rational? If it's rational, then I should be able to quantify the source of the fear with a spreadsheet. Often, that gives us a blueprint for navigating away from a structural deficiency in the economy. However, if the fear is a function of misplaced perception and non-quantifiable, very often such periods of time reveal opportunities of which investors should be mindful. In my opinion, recent market volatility can be attributed to concern over tariffs and the likelihood that such would result in a trade war, growth shock, and a potentially long and deep recession. Also, the Federal Reserve has been under a microscope for the last 5 years, and in my opinion, they remain so today. Geopolitical and geo-economic concerns have also elevated over the last 6 months. Collectively, in my opinion, all of these have conspired to result in a heightened degree of paranoia. And on any given day, our team is devoted to insulating ourselves against that sensationalism as we dispassionately conduct research from a myriad of angles to determine whether the fear of the day is something rational or not. In my opinion, much of the volatility that we've experienced has been caused by irrational fears. And again, in my opinion, there is a disconnect between perception and reality. Within this video today, I'll attempt to address a few of these examples.
Well, I'm sure that our viewers will be interested in hearing about these disconnects between perception and reality. David, you mentioned concerns over the economy, so let's begin there. In your opinion, is the economy on the brink of a recession?
You know, the first formula that I ever memorized as an Economics 101 student was the National Gross Domestic Product formula. It's simply personal consumption plus business investment plus government spending and minus net exports. You get to net exports by subtracting imports, obviously, because if the product was made in a foreign country, then it's not part of our domestic production, right? The Atlanta Federal Reserve Bank maintains a tool called the GDP Now calculator, and it's designed to provide someone with a spot indication of gross domestic product on any given day. Now, in reality, gross domestic product doesn't change that much on a day-in, day-out basis. It's usually very flat and akin to watching grass grow. Mysteriously, around the end of February, we saw a discernible drop in the GDP Now calculator, and this coincided with the time when President Trump began to describe new tariffs and reciprocal tariffs, and the markets began to worry about growth shock and the potential for a long and deep recession. In my opinion, market participants seemingly conflated these tariffs with the sudden drop in the GDP Now calculator and began to factor in a long and deep recession into current asset price valuations. What most people don't understand is that the financial instruments that are included in this calculation that are imported are deducted, and this includes gold bars. For some reason, in the months of January and in December, we imported a record number of gold bars from Switzerland. Well, the nominal value of those imports must be deducted from gross domestic product. Could it be that we may only be experiencing a technical recession because we imported a bunch of gold bars? Sometimes the answer could just be that simple and not a more nefarious conclusion that we may experience a return to the 2008 Great Recession. When the market fog begins to lift and participants begin to reprice for the risk that maybe they were wrong, as history indicates, you don't want to be out of the market when that positive repricing of risk occurs. More on that in just a minute. Over the span of my 34-year career, I have never observed the economy rolling over into a recession when quantifiable metrics are as strong as they are today. In my opinion, it does not appear, anyway, that we're at risk of an economic contraction. It seems counterintuitive that the economy would contract while U.S. industrial production is setting a new all-time record high. We can cross-check that by observing the significant jump in durable goods orders that we observed at the end of April. Another telling metric is the S&P 500 operating profit margin that expanded to 12.4% in the first quarter. This was the highest reading that we've seen since the fourth quarter of 2021. Look, I could cite a myriad of other metrics that, when viewed holistically, paint a much different picture with regard to the economy. In my opinion, no, I do not see a recession looming on the horizon. To give you another disconnect from reality, the stock price of Ralph Lauren recently hit another all-time record high. A loaf of bread is an economically durable commodity. You will eat whether we're in a recession or not. A polo pullover shirt isn't. Those are typically sold in greater quantities when discretionary income is more plentiful. It would appear that the average household finds itself with a greater capacity to spend than the market might have imagined. The media pundit then chimes in, reminding us that average household debt just hit another all-time record high. You don't say. The operative word being another, because that happens every year. If you truly want to understand the health of the average household, you must look at more than half of the equation. Statistically, 88% of the time when we leverage debt, it is for the acquisition of an asset. A house, a car, a boat, an investment property, a business. So if you truly want to understand the health of the average household, doesn't it make sense that you would be more concerned with the household debt to asset ratio? When you observe that metric, you will see that the average household hasn't been this healthy since 1973. For context, I was 5 years old the last time the average household was this healthy. So again, I believe it's counterintuitive to anticipate a return to the 2008 Great Recession when the average household hasn't been this healthy in 51 years. Name your metric, whether it's the ISM Manufacturing Index, the Services Index, durable goods, factory orders, new orders, capacity utilization, personal consumption, or the velocity of money. All of these metrics are pointing to a conclusion other than a recession being around the corner. That doesn't stop market participants from pricing that into current valuations, though, when confronted with fear. My question is, was the fear rational? If it isn't, then we must be stoic in our disposition as we make periods of volatility work for our long-term benefit.
Well, David, that's great information, and indeed it does appear that the economy may be on more solid footing than we'd previously thought. So, how did fear over tariffs play a part in recently observed market volatility?
At a high level, I do not like tariffs. If they are long-term and perpetual in nature, then yeah, it could very well result in an economic slowdown as such tariffs manifest in the form of higher prices paid. In my opinion, however, I do not believe that it is the long-term intent of the administration. In my opinion, these resemble chess moves, with the intent being to incentivize greater geopolitical and geo-economic behavior. The market's response to tariffs was clearly visceral, And I think this had to do with the number of factors, but chief among them was the sheer scope and size of the tariff strategy. Indeed, there are 2 islands off the coast of Australia that are inhabited by nothing but penguins that are subject to the 10% global unilateral 10% tariff. We have since learned, however, that countries are returning to the negotiation table. Unfortunately, sometimes saber rattling and bluster are required before a meaningful attempt to renegotiate geopolitical and geo-economic concerns can be achieved. Is it working? Well, we'll continue to evaluate that over the course of the coming months, but in my opinion, it seems to be border crossings are significantly lower at our southern border. We are actively engaged with both Mexico and Canada to restore what had previously been known as the North American Free Trade Agreement, where we are trading with each other under a 0-for-0 tariff arrangement. We're negotiating the amount of dues that we pay into NATO. Recently, the United States and China made significant progress toward economic détente. They call Alabama the Michigan of the South for a reason. We are home to the plants of Mercedes and Honda, Toyota, Hyundai, Kia. The market has fretted over tariffs that might be imposed on automobiles imported into the United States. Well, eventually the market realizes that a great many of the cars that are sold in the United States are actually made here in the United States and thus not subject to import tariffs. Furthermore, Mercedes-Benz recently announced that they would expand manufacturing capacity in their Alabama plant so that more models could be made here domestically. Indeed, we're hearing from many manufacturing companies describing their efforts to repatriate activity to the United States. Now, we won't likely feel the impact of that overnight, but we could potentially see that manifest in stronger domestic economic data next year and in the years to come. Again, markets are normally discounting mechanisms unless they are confronted with sudden and sharp changes to previously made assumptions. This is where we must be stoic in our analysis of the data in question, whether it was rational or not. In my opinion, I believe that tariffs were intended to be shorter-term chess moves, and we are already beginning to hear about progress being made toward geopolitical and geo-economic results. If recent positive moves in the market are any indication, I think market participants are once again beginning to discount the future in today's valuations and are possibly concluding that previously made assumptions about a long and deep recession weren't valid.
Well, very interesting. So, David, how do you counsel your clients through periods of unrest like we saw in April? Can history give us any guide to follow during times like these?
I believe so. Again, there are many examples of progress about which we are only now hearing in the media, but I do believe that markets are beginning to shake off the malaise of a potential growth shock-induced recession. So how can I quantify that? Well, the drawdown that we experienced at the beginning of April was historic and arguably the fastest and sharpest that we had seen in over 100 years. This was a faster drawdown than what we experienced during the COVID pandemic. Since 1990 and over 1,800 weekly VIX readings to quantify volatility, we have had 11 discernibly high volatility spikes. The most recent was the highest of the 11. Okay, well, what does history tell us about such periods of volatility? Over the 12 months that have followed 9 of the previous 10 VIX spikes, markets were higher by an average of 24%. The only time that we did not observe that pattern was during the COVID pandemic. We just experienced the tallest of all of the 11 spikes since 1990, so what do you think happens next? Now, observing history is no guarantee of the future. Maybe it doesn't repeat itself, but it often rhymes. Credit to Warren Buffett. We have also seen charts like this over the years, where over any rolling 20-year period of time, if you remained invested throughout the ups and the downs, your rate of return was pretty strong. However, if you simply missed the best 10 days that we had during that 20-year period of time, returns are more than cut in half. Frankly, if you miss the best 30 days within any rolling 20-year period of time, you're doing well to simply break even. The paradox is that very often many of the best 10 days that you don't want to miss come on the heels of some of the worst days, such as the ones that we experienced at the beginning of April. On Monday, the 12th of May, that was one of those top 10 days that you didn't want to miss. So again, we've talked often about investment allocation being a function of investment objectives that can be quantified within a holistic, comprehensive plan. We don't randomly throw money at the market. In other words, there's a quantifiable objective that we're trying to achieve with our approach to investment allocation. When you can view things that way, the day-to-day movements of the market through this lens, your eyes on the horizon, in other words, and not on your shoe tops, then it becomes easier to survive periods of time like this and market dislocation. You don't find yourself navigating the emotional cycle that comes with attempting to avoid volatility and time prosperity. It's never worked that way, and it doesn't work that way today. So in conclusion, first I would encourage all of your viewers to engage a professional source of financial planning to codify goals and objectives, and within that output, let it be a blueprint for how an investment portfolio should be allocated. Secondly, I would critically evaluate periods of heightened anxiety when they occur. And again, work with your financial professional to think spherically and not be satisfied with superficial observations. Third, be stoic in your disposition to asset allocation. Dilute cost basis and buy more shares of companies which you had previously valued enough to bring into your portfolio when you discern a disconnect between perception and reality. And lastly, don't be so focused on where we are today, but rather keep your eyes on the horizon. Arriving at the destination isn't as important as how you arrived at the destination. Arriving at the destination is a function of how you journeyed toward that end. I think the period of time through which we're navigating now is a testament to that conviction.
Well, David, as always, thank you so much for this information, and for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.